All right. Thank you very much, Ishika, for getting us all of those details related to the market rally that we saw. And of course, ladies and gentlemen, to decode this rally further, I'm now joined by Sunil Subramaniam. He's a market expert, and along with him, Mr. Rajay Bagga. He's also a market expert. Thank you very much, gentlemen, for taking the time out and speaking to us here on ETNOW. Let me come to you first, Mr. Bagga. Now, both the benchmarks today blasted past the all-time high marks. How would you describe this market texture? Would this be a bit premature to call this a bull market just yet?
Yeah, definitely. 14 months we have taken to recapture a level that we hit on September 27th of last year. So 14 months we have not had returns from that level, if you see. So overall, and as you mentioned in your segment, it has been a concentrated rally with about 23 stocks in the Nifty still below their all-time peaks. If you look at the broader market, a number of stocks, a majority of stocks are about 10% of their last year's peak. So that recovery has to still set in, has to become more broad-based. And the issues that led to this kind of a meandering market, those stay, which are higher relative valuations for India, the lack of pure play artificial intelligence companies which could attract foreign capital, FPIs regularly selling out. And if you look just below the hood at the second order issues, the biggest issue I would say is the promoter selling and the PE fund selling. If you look at even the IPOs, which have raised huge amounts, record-breaking amounts, a massive portion of the IPOs has been through OFS. The companies actually have garnered some 40,000-50,000 crores out of the total. Most of it has gone to existing investors. So if promoters are selling and retail is giving an exit to those promoters, also they're giving an exit to FPIs. It's not a very strong market.
Well, thanks for those insights. But Sunil, regarding, the bank rallying, and also previously you noted that DIIs have been the key buyers while FIIs sold. With FIIs returning as net buyers, how do you think this might change the dynamics for the banks, and what should investors watch out for?
So I think first thing, I'm broadly in agreement with what Ajay said here. But just I want to point out a couple of things where I might take a different note here. The first is that if you see, it's needed a very small return by the FIIs to take the market to the all-time high. The DIIs have been consistently buying and keeping the market afloat. So if you're a Hindi movie fan, there is something, the villain called Ajit in the movies, who used the term called liquid oxygen. His hero को डुबा दो liquid oxygen में, लिक्विड इससे जीने नहीं देगा और ऑक्सीजन इसे मरने नहीं देगा. So the DIIs are the ones who have not allowed the market to fall, kept it at around those levels, and the FII consistent selling has meant the market couldn't touch it. With the moment over the last few days you saw a little bit of FII positivity, the market touched a lifetime high. So from a direction for the future, right, it's the FIIs, because the DIIs are continuing to get 25,000-30,000 crores through SIPs every month, and they will continue to buy. There will be some sector rotation, but they'll continue to buy. So the point is that, is this the sign of an FII return, is the question. And to me, it's now looking much better than last year or 6 months before or 3 months before, for the simple reason that the fact that other markets have delivered very good returns to the FII. So come November to December 15, 20th, there's the profit booking time for the hedge funds. But they will book profits only where they have made profits. And this year, India hasn't been a market where they made money. So they're going to be booking profits in South Korea, Taiwan, China. And second part of it, why would that come to India? Because there's not going to be much profit booking in India. It's because of the fact that most brokerage houses that I have tracked have said that this quarter's earnings was a trough. The second half is going to be better, and for next year they are projecting a 14% return even for the Nifty, and better for the broader market. So to me, a small change in the FII outlook can sustain, but It's the trade deal which needs to get sorted for a big return of the FIs to happen, which can happen anytime over the next few months. So, as an investor, you ask me the question, what do? You stay invested, you stay diversified, and the day that the trade deal is solved,
Right.
I'm not a pessimist who says that we'll never solve the trade deal. I think it'll happen 3 months, maybe 6 months.
Right.
But when that happens,
Right.
you can't catch this market because DIFs are going to sustain. And so to me, this lifetime high is not the thing to look for. You have to look at when is it going to hit 27,000. So to me, that's the journey. And if you're a believer in India,
Absolutely.
you believe that this will
Absolutely.
get solved, then you stay invested, keep diversified. Don't try to pick and choose your sectors because let the earnings pan out over the next year. But I remain
Okay, so
optimistic.
Mr. Subramaniam, you've answered a very crucial question in terms of what should investors be doing. They should remain diversified, given the fact that we are seeing, domestic investors, being the heavyweight investors as far as this market rally is concerned. But there seems to be some issue with respect to FIIs, even though very recently we've seen a return of FIIs. But let me take that question across to you, Mr. Bagga. Do we see FIIs returning for a longer period of time on the back of this rally? How do you map the FII movement, especially as far as emerging markets are concerned?
You have an option of across global emerging market funds. Unless you are a dedicated India fund or you are a passive investing into an India ETF, then you have to come into India. But if you have a choice and you see that there are AI plays, there are other plays that are coming for you, or the broader market is cheaper, is offering you much more value with a little bit less growth, but not substantially lesser growth, then the option becomes clear. So what do we have to deliver to get the FPIs back on a sustained basis? One, strong earnings growth, what Sunil sir mentioned. I think the trough has happened in September. We've had fiscal stimulus, monetary stimulus, RBI cutting rates, and the consumption boom post the GST. All that is helping. However, our valuations remain an issue. So unless you are getting mid to high double-digit earnings growth, you can't justify these valuations. Second, currency. So when rupee starts stabilizing, normally you see FPIs get quite attracted to the market. This year, our rupee has been the worst performing Asian currency. So that also has hurt the foreign currency returns for foreign investors. Again, most of them don't hedge because the cost is very high of hedging. So they ride along. They're taking the equity risk premium of the Indian market. That's what they are investing for. So they don't take the currency hedge. And then if the rupee goes down 4.5% like it has gone this year, then that incremental flow dries up. So I think things will get better sometime next year. I think, yes, the US trade deal will happen. Unfortunately, despite being so small in the scheme of things, because of the sentimental reason. Secondly, because of the risk that if you get Trump irate too much, you could risk the software exports. That is what is at the back of investors' minds. That's why they would like this settled and good relations with the US to happen because of the risk to the software exports.
Right, Mr. Bagga, since you also mentioned rupee, what's your forecast for rupee for the next 12 to 18 months? And is, India entering the depreciation cycle, according to you, that investors are ignoring?
So we have been, when I started working, the rupee was at 16 rupees to the dollar. So we have been in a depreciating cycle. In the 1991, Manmohan Singh did it in one go, and we saw that shock. But otherwise, it has been steadily depreciating, and the RBI also doesn't try to protect the rupee. When I started working, we were nearly on par with the Thai baht. And despite 1998 Asian financial crisis, all those things happening, the Thai baht today is so much stronger than us. And it is an economy that is dependent on tourist flows. So despite that, they have managed it. Our, regulators and our currency managers somehow have been more laissez-faire, that let the rupee find its own value. I think you have to budget in about a 3% depreciation per year. That's what the FIs really factor in. Does it get worse? I don't think so, because the oil prices falling, plus the productivity rising, the oil intensity in the GDP is reducing, the renewables that are coming in are helping us with that. So I don't foresee continuously depreciating rupee, but it won't appreciate also, because somewhere our thinking is still of the 1990s of letting the currency be weak to help the exporters, while there are enough measures which show that that's not a given. That's not really what causes your exports. There's a lot of productivity, there's a lot of good logistics, and massive amount of capital being invested. Today, if you look at Indian labor productivity, so if we are at 1, China is at 2, Europe is at 12, US is at 8 versus the Indian productivity. And that most of it is not that we are not hardworking or not, it's more the capital issue.
Right. Absolutely. But Mr. Bagga, essentially what you're stating is that there are some kind of policy interventions which are needed to arrest the depreciating rupee, and we can't really just be dependent on external factors and of course the dollar readjustment as far as currency movements are concerned. But let me come to you, Mr. Subramaniam. Mr. Subramaniam, you mentioned about a very important factor, something that we've been tracking since the beginning of this year, and that is related to the India-US trade deal. Now, we've been given to understand by government sources that that deal is imminent, that the deal is happening soon, and there might not be any need for any further talks. But that seems to be a big market mover going forward in the future. What are you anticipating in terms of when is this deal likely to get sealed, or at least an initial package?
So let me look at it this way. First of all, you look at it in the context of Mr. Trump trying to solve the Russia-Ukraine war. The latest effort that he does to it. And if there's some slight progress toward, the first thing that can happen is the additional 25% tariff can go away. So whether the trade deal gets signed or not, if it only needs for the additional penal rate which was charged for Russian imports. Now Russian imports are coming down. They put sanctions on those 2 companies there, and already that part Mr. Trump is claiming a win, saying, oh, India has stopped its Russian exports or reduced it. We are also signed an LPG deal with America to buy more gasoline from them. So from that perspective, I see that the 25% has a good chance of going away. And then the trade deal, which I would say give it at least 3 months to sort it out, because the red lines still remain. But the effect of this 25% going away and the trade deal likely to be signed has its effect on the currency, which Ajay referred to. I just want to point out there that I think the RBI allowed the rupee to weaken because of the additional tariff. It was a defensive measure against the tariff. But as you see, an additional 25 going away and perhaps a trade deal being signed, RBI wouldn't need to do that. So I think that the rupee can be stable. And FIS, as Ajay correctly pointed out, the interest rate differential between the two GSECs is 2.5%. So hedge funds and others do take a 2.5% depreciation as normal and factor it into their investment. So I don't see the rupee depreciating beyond that 2.5%, and any news on the trade deal could lead to a short-term appreciation of the dollar. Now, that being said, the other perspective that I have on the trade deal is that FIS also, having suffered almost a 6% year-on-year depreciation of the rupee, will say that it's not going to depreciate that much, and it might be a good entry point from a currency perspective itself for FIS to enter the Indian market. So from a trade deal perspective, I think it's very all important. And I think that the latest tweet from the trade minister says that it could be announced in a matter of hours. Now, we have heard such a wolf cried wolf story for a long time for us not to jump at these things. But all things considered, it looks like we are moving closer to a trade deal. And I think the new year may herald good news, and keep fingers crossed on that.
Right. Mr. Subramanian, like the golden question, and you also briefly discussed that, investors should stay invested. But what is the investment strategy overall that, the investors should adopt going forward? And what are some of the metrics that investors should use to determine whether going forward this rally is overextended, and how should they adjust their portfolios accordingly?
See, I think that overall, if you look at it, nothing better than the Warren Buffett ratio. The market cap to GDP. I think India is off from its highs of 145 odd % down to the mid 120s. So that means that hey, we are more than 100, so we are not cheap, but we are off our highs. And if you take valuations from a 5-year average perspective, we are round about close to the 5-year average. We are obviously still not cheap. So from a valuation, from what I'm trying to say is from a domestic investor perspective, right? From the domestic economy is chugging along. I think Ajay pointed out a number of the positive factors that have taken place recently. Plus, in January, you have the new pay commission getting announced. In budget, you'll get a budget with stimuli coming in, and you'll probably get a set of banking mergers in the PSU banks and further liberalization on their lending. Already, RBI has done a lot. So, I would say when you then look at it, you look at the domestic oriented sectors as your core holding. So, banking and financial services and the consumption boom, which Ajay referred to, I think will lead to a capacity utilization increase. And I see in the next year, in 2026, the private capex will pick up speed. So I think investors need to stay focused on core India, domestic India, and use the BFSI space plus the infra related space to put their core holdings. And a bit of risk taking would be betting on the tariff affected sectors like a textile, pharma, even IT and this, though they are not directly tariff affected, FI's return would boost them. So I would suggest that you still say 75% domestic focus and 25% you can play a potential return of the FII, which means for solving of the trade deal and hence the bounce that can happen in those export oriented spaces. So you shouldn't ignore that because buy low, sell high is ultimately the mantra. So something is going low, do allocate a little bit, don't ignore it fully. That's my suggestion. So best way then to play it is, I would say, multi-cap funds which have small cap, mid cap, large cap, equal almost allocation, so that they don't, small cap is the most underperforming 1 year and mid and large caps have been equal. So I would say keep multi-cap as your core, and I would say multi-asset allocation, because gold may not deliver another 50% return. But the way things are going on the China front and sovereign wealth gold buying, there will be a decent return there. So multi-asset allocation gives you some allocation to gold, which is also an emotional thing for Indian investors.
Right.
So I would say multi-cap plus multi-asset allocation should give you a good diversified play into the coming future.
Absolutely, an investor should ensure that there is a diversification in his or her portfolio, and those are some of the segments that you just spoke about. But Mr. Bagga, let me come to you now. In terms of the market rally, we have spoken about the fact that valuations continue to trade at a premium, and of course, JP Morgan has also stated that Nifty is likely to close the year around 30,000. Would you be an Indian market bull? Would you agree with what JP Morgan is anticipating as far as the Indian market is concerned, or are there any risks to the rally that you foresee?
Yeah, you see, most Indians are Indian market bulls, and we will make a lot of money just by the mega trend called India. So that goes without saying. I remain a bull. I'm not very convinced about this rally. Historically, what happens on a median level, markets tend to go down or consolidate for 10 months. This time it's been 14 months, slightly higher, but not the highest that we have seen in previous frenzies. So it was not euphoria, it was not frenzy. But what is risky, just one door away, is the promoter selling. Promoters selling out 2 lakh crores. They are not seeing value in their companies. MNC CEOs coming in and saying that, we get listed at 10 times price to earning. Here we are getting 50. So I am doing a block deal and taking out some liquidity from India. This is an open statement yesterday. Those are risk issues. Yes, we will be proved right on a 10-year basis. The retailer who continues to do the SIPs will make a lot of money. But I'm not very clear that we are going to see it over the next 12 months on an immediate basis, because the earnings have to now follow through. Maybe the trough has been reached, but what if it's an L shape, like what happened to Japan? Japan was in 1993, Japan was a $4 trillion economy. It is still a $4 trillion economy. So we have to be careful. We can't take it for granted that China, which was 2007, a $4 trillion economy, today it is 19 trillion. We will have the trajectory of a China. We can't take that for granted. I think a lot more has to be done on the regulatory front. A lot of capital has to come into the country, and the secondary market is suffering because of a white hot primary market. Secondly, the liquidity, what Sunil sir mentioned about liquid oxygen. Liquidity is the oxygen for the markets. And there the secondary markets are suffering because promoters are going on giving supply after supply. And the retailers are running in and absorbing that supply. Earlier, what used to happen when we didn't have such a strong retail base, the markets used to fall sharply. So it was a self-correcting capitalist mechanism. Markets are forward discounting adaptive mechanisms. Now what has happened is the retailer is coming in and saying, you keep punching me, I will keep coming in with more money. No problem. So that correction has not happened. If you had fallen fast, your valuations would be very good. Today I would be saying, go in and mortgage your house and put money into the market. I don't think we are at that level. We are very not at all cheap. Yes, we have underperformed with the EMs. Historically, when we do that, when we fall and we underperform, next 12 months are very good. So historical precedent is saying that we should do well. All your big wirehouses are saying that we will do well. Somewhere in my gut, I have a feeling we are not out of the woods. And I don't know what will be the catalyst, because the US trade will take away a negative. It won't bring in a positive. What we need is like 17-18% kind of earnings growth. We need a nominal GDP growth of 12. Your inflation has gone down so much that we are hitting a 12% nominal GDP has become difficult. I would be very worried if I was the government, because you need massive public works, you need massive amount of spending now, and the RBI has to come in. You can't have a real interest rate of 5% when your inflation is down to 0.25, you're running at 5.25. You are really destimulating the economy. Your corporates are still borrowing at very high rates. You need to cut rates, which RBI didn't in October. Now the governor has said he has space, hopefully on 5th he cuts rates. That's very good. But a lot more needs to be done.
So you're warning of the potential risk. Also, there are conversations of the China turnaround story. So if there is indeed a turnaround that happens in the next couple of months, Mr. Bagga, is there a tail risk that no one wants to talk about, that investors might also, probably put India second on the list then?
Yeah, we are not second. We are fourth, fifth, because there is Europe, there is Japan, there is Korea.
But the whole sentiment is upbeat, about India. That's what I'm speaking about.
Yeah. Sentiment is upbeat, and there is, from Goldman to HSBC, Morgan is a perma bull on India. So we take that. Normally we discount that out. JP has come out with 30,000 for next. What Sunil sir mentioned, if this FPI intensity even reduces, and then the retail are bringing in enough. But the caveat there is the promoter is going on selling. You don't see that in other markets. Or there should be a strategic promoter coming in, buying out that. Here the retail Indian is buying, which they can't influence those companies, nor are they strategic investors. They are financial investors. They are depending on the India story. So unless these promoters stop selling 250,000 crores a year, it's very difficult for our markets to really sustain that 14-15% return. That will always come in. A promoter comes in and keeps on reducing their stake. Yes, governments do it, that is fine. We can bear that much, the government doing it. But promoters going on selling, or PE funds cashing out, because they have $10 billion stuck, they have taken out $2 billion this year out of the Indian markets. It's made an impact on us.
Absolutely, Mr. Bagga, but we'll have to see the kind of, market trends that we are going to see in the coming few months, in fact, the coming few weeks. The point about you stating that the biggest issue as far as IPOs are concerned is the massive promoters selling. And of course, that is happening through OFS, whether that gets arrested or not. But more importantly, whether there's going to be a sustained momentum to this rally that we've seen in the markets today, that remains the big question. And of course, how India really fares as far as global risks are concerned, that remains to be seen as well. But for the moment, thank you very much, Mr. Subramaniam and Mr. Bagga, for taking the time out and speaking to us here on ET Now.
Thank you.